Hello, friends. Today, we're diving into one of the most powerful trading books ever written, Think and Trade Like a Champion by Mark Minervini. If you're serious about mastering the stock market and want to trade like the pros, this book is a game changer. Mark Minervini isn't just another trader. He's a U.S. investing champion who turned a small trading account into millions using a disciplined, rule-based approach. In this book, he reveals the exact strategies that helped him achieve consistent profits. And the best part? These aren't just theories. They're real-world techniques that actually work. This book isn't about stock tips or quick money schemes. It's about developing the mindset, strategy, and risk management skills that separate amateur traders from true champions. Minervini lays out a clear, step-by-step process for entering trades, managing risk, and exiting with profits, all while keeping your emotions in check. Here's what you'll learn in this book. 1. Always go in with a plan. Why trading without a strategy is a recipe for failure. 2. Approach every trade risk first. How to protect your capital before thinking about profits. 3. Never risk more than you expect to gain. The key to smart risk-reward ratios. 4. Know the truth about your trading. The importance of tracking your performance. 5. Compound money, not mistakes. How to scale your trading without blowing up your account. 6 and 7. How and when to buy stocks, part 1 and 2. The exact techniques for finding winning stocks and perfecting your entries. 8. Position sizing for optimal results, maximizing gains while keeping risk under control. 9. When to sell and nail down profits, the science of taking profits at the right time. 10. 8 keys to unlocking super performance, the core principles of elite traders. 11. The champion trader mindset, the mental framework that keeps you disciplined and focused. Now, before we jump in, let me tell you about another incredible book we covered in our last video, The Hour Between Dog and Wolf by John Coates. This is one of the best books on trading psychology, explaining how biological changes in our body affect our decision-making in the markets. Honestly, I found it fascinating, and you should definitely check it out. That video didn't get the best response, but I truly believe it's one of the most valuable books I've come across. So, if you missed it, go watch it. You won't regret it. All right, let's get started with Think and Trade Like a Champion. And don't forget to like, share, and subscribe for more powerful trading insights. 1. Always go in with a plan. Trading without a plan? That's like setting sail without a map. You're bound to drift aimlessly, crash, or worse, sink entirely. Mark Minervini starts this chapter by drilling in a crucial lesson. Always go in with a plan. And not just any plan. A well-thought-out, structured, and disciplined approach that keeps emotions in check and decisions razor-sharp. Now here's where things get interesting. Minervini introduces us to 2 types of traders that live inside every person, the builder and the wrecker. The builder is disciplined, methodical, and focused on the process. This is the trader who sticks to the rules, follows a structured strategy, and doesn't let emotions dictate actions. On the other hand, the wrecker is driven by ego, obsessed with short-term results, and constantly second-guessing every move. This is the trader who chases stocks, ignores stop losses, and eventually burns their account down to ashes. So, what does a real plan look like? Minervini breaks it down into key components. 1. Entry strategy. You don't just randomly jump into a trade. There needs to be a specific reason for entry, whether it's a breakout, a pullback to support, or some other high-probability setup. Every trade should have a clearly defined trigger point. 2. Risk management. This is where most traders fail. Before entering a trade, you must define your stop loss. How much are you willing to risk? If a stock moves against you, at what price do you cut your losses? No guesswork, just pure discipline. 3. Profit-taking rules. You need a system for exiting with a profit, not just when you feel like it. Whether it's scaling out, trailing stops, or hitting a predefined price target, you should always know your exit before you enter. 4. Position sizing. How much capital should you put into each trade? Minervini warns against putting too much in a single trade, which could wipe you out. Smart traders size their positions based on risk, ensuring no single loss is catastrophic. 5. Contingency plans. What happens if the market suddenly turns? What if your stock gaps down overnight? A good plan includes what to do when things don't go as expected. You don't freeze, you execute. Minervini warns about falling into the paralysis regret cycle, where traders hesitate to enter a trade, finally jump in late, and then regret it when things don't go as planned. This cycle leads to bad decisions, like revenge trading, chasing stocks, or holding on to losers in the hope they'll come back. A solid plan eliminates this cycle because decisions are made before emotions take over. Bottom line, plan first, trade second. The best traders don't hope or guess. They execute based on preparation. Every trade has a purpose, every risk is calculated, and every outcome, win or lose, is part of a bigger strategy. 2. Approach every trade risk first. Most traders make the same mistake. They focus on how much they can make, but they ignore how much they can lose. That's a recipe for disaster. Mark Minervini flips this mindset completely. Before you even think about profits, you need to focus on risk. Think about it. Every professional in a high-stakes field, whether it's a surgeon, pilot, or elite athlete, is trained to minimize risk before going for success. Yet, in trading, most people do the opposite. They jump into trades hoping for big wins without ever considering the worst-case scenario. That's exactly why most traders fail. Define your exit before you enter. Minervini lays down a simple but powerful rule. Know your exit before you take the trade. This means setting your stop loss before you even click that buy button. It's not about reacting to the market. It's about being prepared for any outcome. Fixed stop loss. You set a price level where you will cut your losses, no exceptions. If the stock hits that level, you get out. No hesitation. No, maybe it will bounce. Percentage-based stop. Instead of a fixed price, you risk a specific percentage of your capital per trade. For example, if you risk 1% per trade, a string of losses won't wipe you out. Technical stop. You place your stop at a logical level based on support, resistance, or trend lines. This ensures you're not getting shaken out too early, but still protecting your downside. Minervini stresses that this isn't just a suggestion, it's a survival strategy. Trading without a stop loss is like driving without brakes. It's not a matter of if you crash, but when. The danger of mental stop losses. A common mistake traders make? They use mental stop losses instead of setting them in the system. They tell themselves, if the stock drops below this level, I'll sell. But when it actually happens, emotions take over. Instead of exiting, they start making excuses. Let's just wait a little longer. Maybe it'll bounce back. I'll sell if it drops a little more. Next thing they know, a small loss turns into a huge one. The lesson here? Never rely on mental stop losses. Put them in the system and stick to them. Avoid emotional decision-making. Minervini doesn't sugarcoat it. Quote, your emotions are your worst enemy in trading. The moment you start making decisions based on fear, greed, or hope, you're done. That's why having a predefined risk plan is so critical. When you follow a structured approach, you take emotions out of the equation. Here's what separates winners from losers. Losers trade based on feelings. They let emotions decide when to enter, exit, and hold on to losing trades way too long. Winners trade based on strategy. They follow their plan, manage risk first, and execute with discipline. Risk-first mentality, long-term survival. Minervini's approach is clear. Trading isn't about making money fast. It's about surviving long enough to get good. If you're constantly blowing up your account, you'll never get a chance to improve. The traders who last are the ones who protect their capital first, profit second. So next time you enter a trade, ask yourself, do I have my risk plan in place? If not, you're gambling, not trading. And in trading, gamblers don't last. 3. Never risk more than you expect to gain. Imagine flipping a coin. Heads, you win $1. Tails, you lose $2. Would you take that bet? Of course not. It's a losing game. Yet, this is exactly how most traders approach the market. They risk more than they stand to gain, and then wonder why their account keeps shrinking. Mark Minervini breaks it down with one golden rule: never risk more than you expect to gain. This isn't just about avoiding losses. It's about structuring your trades so that over time, you're set up for success. The math of trading success. Minervini emphasizes the power of a favorable risk-reward ratio, meaning the potential reward on a trade should always be greater than the risk. He gives an example. If you risk $1 per trade, you should aim to make at least $2 or $3 in profit. This means your risk-reward ratio is 1:2 or 1:3, which ensures that even if you only win half your trades, you'll still be profitable. Now, let's flip the scenario. If a trader risks $2 to make dollars, they would have to win more than 66% of their trades just to break even. That's an extremely difficult game to play, even for professionals. Why most traders lose: bad risk-reward ratios. Minervini points out that the majority of traders lose money not because they can't find good trades, but because their risk-reward setup is flawed. Here's what usually happens. They take trades where they risk $5 to make $2, thinking they feel good about it. When they lose, the damage is much bigger than their gains. Even if they win 60% of the time, their losses still outweigh their profits. This is what Minervini calls digging a hole you can't climb out of. The key to long-term profitability? Always structure trades where your potential gain outweighs your potential loss. Small wins won't save you. Big losses will destroy you. A lot of traders make the mistake of focusing on their win rate instead of their risk-reward ratio. They feel good about winning 7 out of 10 trades, but what they don't realize is that if their losses are much bigger than their wins, they'll still end up negative. Example: Trader A wins 7 out of 10 trades but risks $2 to make $1. Over time, they still lose money despite winning more often. Trader B wins only 4 out of 10 trades but risks $1 to make $3. Even with a lower win rate, they come out ahead. This is why Minervini drills one thing into every trader's mind. You don't have to win all the time. You just have to make more when you win than you lose when you're wrong. How to structure a winning trade. Minervini lays out a simple checklist for making sure you never risk more than you expect to gain. 1. Before entering a trade, define your stop loss. Know exactly where you'll get out if the trade goes against you. 2. Set a price target that is at least 2 to 3 times greater than your stop loss distance. If your stop is at $50 and your target is $55, that's a 1:1 ratio, which isn't good enough. You need at least $60 as your target to make the trade worth it. 3. Stick to the plan. No adjusting your stop loss to avoid a loss. A lot of traders move their stops lower as the stock drops, hoping it'll recover. That's just a slow-motion disaster. Minervini makes one thing clear. Trading is not about being right all the time. It's about making sure that when you're right, you make enough to cover your losses and then some. Professional traders don't stress about individual trades. They focus on playing the long game, making sure that over a series of trades, their winners outweigh their losers. So before you take your next trade, ask yourself, is my reward big enough to justify my risk? If not, walk away, because in trading, a bad bet is worse than no bet at all. 4. Know the truth about your trading. Let's be real. Most traders lie to themselves. Not intentionally, but through self-deception and selective memory. They remember their big wins, downplay their losses, and convince themselves they're doing better than they actually are. This is why most traders never improve. Mark Minervini lays it out bluntly. If you don't track your trades with cold, hard numbers, you have no idea how good or bad you really are. And without that truth, you'll never fix your mistakes or refine your strategy. Why you must track your trades like a business. Imagine a restaurant owner who doesn't track inventory, sales, or profits. He just guesses how much food he needs and hopes for the best. How long do you think that business will survive? Now think about traders who jump in and out of the market without tracking their performance. They might feel like they're doing well, but they have no proof. Minervini compares this to running a business blindfolded. Successful traders track everything, because if you don't know where you stand, you can't improve. The core metrics every trader must track. Minervini breaks it down into key performance metrics that separate serious traders from gamblers. 1. Batting average, win rate. What percentage of your trades are winners? But remember, a high win rate means nothing if your losses are bigger than your wins. 2. Average win versus average loss. Are your winners bigger than your losers? This is more important than win rate. Even with a 40% win rate, if your average win is twice the size of your average loss, you'll be profitable. 3. Risk-reward ratio. How much do you typically risk compared to how much you make on a winning trade? If you're risking $2 to make $1, you're in trouble. Minervini recommends aiming for at least a 1-to-2 or 1-3 ratio. 4. Biggest winner versus biggest loser. Your worst trade should never be way bigger than your best trade. If your biggest loser wipes out weeks of gains, you're trading too recklessly. 5. Consistency over time. Are you making steady progress, or is your equity curve all over the place? A few big wins don't mean much if they're followed by even bigger losses. Why most traders avoid keeping records. Minervini points out that the real reason most traders don't track their trades isn't laziness, it's fear. They don't want to face the truth about how much they're really losing. They prefer to blame the market, bad luck, or manipulation rather than admit their own mistakes. They think keeping records is boring and doesn't matter, but the traders who do keep detailed records are the ones who improve the fastest because they treat trading like a skill that can be refined. How to track your trading like a pro. Minervini suggests setting up a trading journal where you log every single trade with entry and exit prices. What price did you buy sell at? Position size. How much capital did you risk? Reason for entry. Why did you take the trade? Was there a setup or just a hunch? Stop loss and target price. Where was your risk defined? Did you follow your plan? Outcome and emotion check. Did you stick to your rules? Did emotions affect your decision? When you look back at this data, after 50+ trades, you'll start seeing patterns, both good and bad. Maybe you realize you're cutting winners too soon. Or maybe you see that every time you break your stop loss, the trade ends badly. This is how you refine your strategy. The power of data-driven trading. Minervini's message is clear. The best traders make decisions based on real data, not feelings. If something isn't working, they don't make excuses, they adjust. By keeping detailed records and studying your results, you'll start seeing exactly what's making you money and what's costing you money. And once you have that clarity, you can start eliminating the bad habits that are holding you back. So if you're serious about becoming a champion trader, start today. Track every single trade. Because in the end, the market doesn't care about your excuses, only your results. 5. Compound money, not mistakes. Compounding is the dream, right? Turning a small trading account into something massive over time. But here's the catch. If you compound mistakes instead of smart decisions, your account won't grow, it'll shrink. Mark Minervini doesn't just talk about making money, he talks about keeping it. And in this chapter, he lays out the hard truth. Most traders sabotage themselves by increasing risk before they're ready. The illusion of rapid growth. Every trader fantasizes about that one big trade that turns a small account into a fortune. But Minervini warns against falling into the trap of scaling up too soon. Here's what typically happens. 1. A trader has a few winning trades and starts feeling invincible. 2. They increase their position size, thinking they're on a hot streak. 3. Then, bam, a losing trade wipes out weeks or even months of progress. This isn't compounding. This is gambling. Compounding should come from a proven, repeatable process, not from emotional overconfidence. Before increasing your position size, you need consistency, discipline, and rock-solid risk management. Why most traders fail at compounding. Minervini points out that compounding only works when done strategically. Most traders make these critical mistakes. Compounding too soon. They increase position size after a few wins, without real proof they've mastered their strategy. Ignoring risk management. Instead of compounding gains, they compound losses because their risk controls are weak. Chasing bigger returns. They start thinking about how much money they could make instead of focusing on trading well. Minervini's advice? Earn the right to compound. Master the process first, then scale up. Compounding gains, the right way. So how do you safely compound your trading account without blowing it up? Prove consistency first. Don't increase size after a few wins. Show consistent profitability over months before thinking about scaling up. Increase size gradually. Instead of doubling position sizes overnight, increase them slowly, step by step. Stick to your risk percentage. If you're risking 1% per trade, keep it at 1%. Don't let overconfidence push you into risking more just because you're winning. Use profits, not principle. The best way to compound is to increase size using profits, not your original capital. This way, even if you hit a losing streak, your base capital stays protected. The danger of compounding mistakes. Minervini warns that traders don't just compound money, they also compound bad habits. If you start increasing position size while still making fundamental mistakes, you're magnifying the damage those mistakes cause. Think about it. If your strategy has flaws and you start trading bigger, you'll just lose bigger. If you don't follow stop losses on small trades, imagine what happens when your positions are 5x bigger. If you struggle with emotional discipline, increasing position size will only increase stress and fear. This is why scaling up should come after skill development, not before. The mindset shift, slow and steady wins. Minervini is brutally honest. Most traders fail because they're impatient. They want fast results. They think bigger trades will lead to bigger profits, but in reality, bigger trades just expose weaknesses faster. If you focus on trading well, the money will come. If you focus on money first, you'll make impulsive mistakes. The key lesson here: trade smart, stay patient, and let compounding happen naturally. Because in trading, it's not about how much you win, it's about how much you keep. 6. How and when to buy stocks, Part 1. Buying stocks isn't about luck, it's about timing and understanding market cycles. Mark Minervini makes it clear. Buying at the right time in the right trend is what separates winners from losers. Most traders jump into stocks randomly, but smart traders know exactly when to enter. So, how do you buy stocks like a pro? It all starts with understanding the 4 market stages. The 4 stages of a stock's life cycle. Every stock moves through 4 predictable stages. Knowing these stages helps you enter at the best time and avoid buying at the worst. 1. Stage 1. Consolidation, basing phase. This is the quiet phase, where a stock is moving sideways with no clear trend. Volume is low, and there's no strong buying or selling pressure. Think of it as a stock loading up before making a move. 2. Stage 2. Accumulation, the uptrend begins. This is where the real action starts. Institutions and big money begin buying, pushing the stock higher. The stock breaks out of its base and enters a strong uptrend. This is where Minervini says you should buy. 3. Stage 3. Distribution, the peak and slowdown. After a long uptrend, stocks start topping out. Big investors begin selling their positions. The stock loses momentum, but many retail traders still jump in, thinking the trend will continue. 4. Stage 4. Capitulation, the downtrend and sell-off. The stock collapses as selling pressure takes over. This is where amateur traders panic and sell at a loss. Smart traders? They avoid this stage completely. Why Stage 2 is the golden zone? Minervini is crystal clear. Stage 2 is where you should be buying. Why? Because that's when institutions are piling in. Big money is pushing the stock up. Volume spikes, showing strong demand. The trend is confirmed, reducing your risk. Buying in Stage 1 or Stage 3. That's a mistake. In Stage 1, the stock is just drifting. In Stage 3, it's already run up and could crash anytime. You want to catch stocks at the start of their run, not the end. The trend template, how to find winning stocks. Minervini doesn't just tell you to buy in Stage 2. He gives you a system to find the best stocks. His trend template helps identify stocks that are strong, ready to explode, and have the highest chance of success. Here's what to look for. 1. The stock is above its 150-day and 200-day moving averages. This confirms the stock is in a long-term uptrend. 2. The 150-day moving average is trending upward. This shows the stock has been strong for a while. 3. The 200-day moving average is also trending upward. A weak stock won't meet this criterion. Only strong, trending stocks do. 4. The stock is trading near its 52-week high. Minervini says strong stocks make new highs, not new lows. 5. The relative strength ranking is high, above 70. Stocks that outperform the market tend to keep outperforming. By following this simple checklist, you eliminate weak stocks and focus only on high-potential winners. Why most traders fail at buying? Most traders don't buy in Stage 2. They either buy too early in Stage 1, hoping for a breakout that never comes. Chase stocks in stage 3, buying at the peak right before the crash. Ignore trend confirmation, jumping into random stocks without a plan. Minervini's advice? Be patient. Wait for the trend, then strike. 7. How and when to buy stocks, Part 2. In the previous chapter, Minervini laid the foundation for when to buy stocks by identifying the right market stage. Now he takes it a step further, breaking down specific chart patterns that top traders use to get in early and maximize profits. Here's the reality. Not all uptrends are the same. Some stocks move in wild, unpredictable swings, while others tighten up before exploding higher. The key? Finding the patterns that signal a high probability breakout. And that's exactly what this chapter is about. The volatility contraction pattern, VCP, a trader's secret weapon. One of Minervini's favorite setups is the volatility contraction pattern, VCP. Why? Because it helps traders spot stocks that are gearing up for a strong move before they actually break out. Here's how it works. 1. The stock's price swings start big but gradually get smaller. Early on, the stock has wide volatile movements. But over time, these swings tighten up, meaning sellers are getting weaker. 2. Volume decreases as volatility contracts. Fewer traders are panicking or selling. Supply is drying up. 3. A breakout happens on a surge in volume. Once sellers are exhausted, buyers step in aggressively, pushing the stock higher. It's like a spring coiling up. The price action gets tighter and tighter, then boom, the stock explodes. Why the VCP works. Most traders look for big, flashy breakouts. But Minervini explains that the best breakouts come after a period of low volatility. Think about it. A stock that jumps up and down erratically is unpredictable. But a stock that steadily tightens up before breaking out, that's a sign that sellers are exhausted. Buyers are taking control. The stock is ready to run. By identifying the VCP setup, traders can enter just before the big move without chasing. The low cheat entry, getting in before the crowd. Now, here's where Minervini shares a pro-level move, the low cheat entry. Most traders wait for a full base to form before buying a breakout. But here's the problem. By then, the stock is already running and your risk is higher. That's why Minervini developed the low cheat entry. It allows traders to get in before the stock fully breaks out, enter at a lower price with less risk, catch an emerging trend early before the crowd jumps in. How to spot a low cheat entry. The low cheat entry works by identifying a pivot point before the stock completes its base. Here's how you find it. 1. Look for a stock in a strong uptrend. The stock should be showing strength above its moving averages. 2. Watch for a VCP setup forming. Price swings should get tighter over time. 3. Find a mini pivot inside the base. Instead of waiting for the full breakout, look for a small resistance level within the base. 4. Enter on a break above the mini pivot. If the stock moves above this early resistance with volume, that's your signal to buy. This method lets you get in before the breakout traders, giving you a head start with less risk. The power of combining VCP and low cheat entries. Minervini's approach isn't about gambling. It's about stacking probabilities in your favor by using VCP to identify tightening price action before a breakout, low cheat entries to enter before the full base forms. Traders can reduce risk because they're entering earlier, maximize gains since they're positioned before the big move, trade with confidence, knowing they have an edge. 8. Position sizing for optimal results. All right, let's talk about something that can make or break your trading success, position sizing. Most traders focus only on picking the right stock, but here's the truth. What really determines your success isn't just what you buy, it's how much you buy. Minervini makes one thing clear. If your position size is too big, you risk blowing up your account. If it's too small, even winning trades won't make a difference. So, the key is finding the sweet spot, a position size that maximizes returns while keeping risk under control. And that's exactly what we're diving into. Why position sizing matters more than you think. Most traders make one of these two deadly mistakes. 1. Going too big on a single trade. They risk way too much on one stock. If it works, great, but if it doesn't, they take a huge loss that's hard to recover from. 2. Going too small out of fear. Even when they win, they barely make any money. Their account grows too slowly to make real progress. Both approaches lead to frustration. That's why Minervini focuses on a calculated, disciplined method of position sizing. The formula for smart position sizing. Minervini keeps things simple. Before entering a trade, you must decide two things. 1. How much of your total capital you're willing to risk on this trade. 2. The distance between your entry price and stop-loss level. Let's break this down. Step 1. Define your risk per trade. Minervini suggests risking no more than 1 to 2% of your total account on a single trade. For example, if you have a $50,000 trading account, you should risk no more than $500 to $1,000 per trade. That means, even if the trade goes wrong, you'll live to fight another day. Step 2. Determine the stop-loss distance. If a stock is trading at $100 and your stop-loss is set at $95, that means your risk per share is $5. Now, divide your total risk per trade by the risk per share. For example, you decide to risk $1,000 on this trade. The risk per share is $5. So, the correct position size is $1,000 equals 200 shares. Boom, that's your position size. You're not just guessing, you're using a calculated approach to keep risk in check while giving yourself room for big wins. Adjusting position size based on confidence. Not all setups are equal. Some trades have higher conviction than others. Minervini recommends scaling position size based on the quality of the setup, your past performance, market conditions. For high probability trades, you can increase size slightly while keeping risk under control. But for lower confidence setups, it's better to scale down. The goal? Stay aggressive when it makes sense and defensive when necessary. Avoiding the most common position sizing mistakes. Minervini warns traders to watch out for these dangerous habits. Averaging down on losing trades. If a trade goes against you, don't add more hoping for a comeback. That's a fast track to disaster. Going all in on one trade. No matter how good a setup looks, never risk everything on one stock. One bad move can wipe you out. Ignoring volatility. A stock that moves wildly should have a smaller position size than a slow, steady mover. Adjust accordingly. 9. When to sell and nail down profits. All right, let's get real. Getting into a trade is easy. Anyone can hit the buy button. But you know what separates amateur traders from champions? Knowing when to sell. Minervini makes this crystal clear. If you don't have a solid exit strategy, you'll give back all your profits. If you hold too long waiting for the perfect exit, you might watch a winning trade turn into a loser. If you sell too early out of fear, you'll leave massive gains on the table. So today, we're talking about how to sell like a pro, locking in profits while maximizing gains. The biggest selling mistake, chasing the perfect exit. Minervini drops a truth bomb early in this chapter. You will never sell at the absolute top every time. And guess what? You don't need to. Too many traders try to time the peak perfectly. But let's be real, that's impossible. The market doesn't care about your predictions. Instead of trying to sell at the highest price, focus on capturing a meaningful part of the move. Minervini's mindset? You don't have to catch the top. Just make sure you take a solid profit. Your goal is to be consistent, not perfect. If you bank steady gains over time, you'll crush 99% of traders. 3 selling strategies to lock in profits. Minervini breaks down 3 smart ways to sell without second-guessing yourself. 1. The trailing stop method. Let winners run, but protect gains. Instead of selling at a fixed price, use a trailing stop that moves up as the stock moves up. This way, you stay in the trade while it's strong, but if it starts to fall, you automatically get out before losing too much. Example. You buy a stock at $100. It rises to $120, so you set a trailing stop at $115. If the stock keeps going up, you move your stop higher. If it drops below $150, you sell and walk away with solid profits. Why does this work? It removes emotions from the decision. It locks in gains while still giving the stock room to move higher. It ensures you don't hold on to a trade that reverses hard. Nana 2. The profit target method. Take profits when your plan says to. Before you enter a trade, set a realistic profit target based on historical stock moves. Once the stock reaches your target, sell a portion of your position. This guarantees you walk away with real profits no matter what happens next. Example, you buy a stock at $50 with a goal of $75. When it hits $75, you sell half your shares. If it keeps running, you use a trailing stop on the rest. If it reverses, you've already locked in a win. This method works because it removes the stress of trying to sell at the top. It lets you lock in gains while keeping some upside potential. You never feel like you missed out if the stock keeps running. The market conditions method. Sell based on overall market health. Minervini warns, even strong stocks can collapse if the market turns bearish. If the market is showing signs of weakness, major indexes breaking down, leading stocks getting crushed, reduce your exposure. If the market is strong, you can hold on to winning stocks longer. Example, you have a winning trade that's up 40%, but suddenly the market starts tanking. Instead of hoping your stock survives, you lock in gains and step aside. Once the market stabilizes, you look for new opportunities. This method ensures that you don't give back gains when the overall market is weak. You stay defensive when needed and aggressive when the time is right. How Minervini thinks about selling. If there's one takeaway from this chapter, it's this. Selling should be based on logic, not emotions. Too many traders sell because they feel fear of missing out, FOMO, selling too early because they're scared of a pullback. Greed, holding too long, hoping for a bigger move that never comes. Regret, selling then watching the stock go higher, feeling like they made a mistake. Minervini removes all of this by using structured, rule-based exits. 10. 8 keys to unlocking super performance. All right, traders. If you want to crush the market and achieve super performance, you need to follow these 8 golden rules from Minervini. These are not just tips. They are the backbone of every legendary trader's success. Let's break them down, one by one, in a way that you can apply immediately to level up your trading game. 1. Specialize. Master one strategy like a pro. Ever heard the saying, "Jack of all trades, master of none"? That applies perfectly to trading. Many traders make the mistake of chasing every single opportunity, scalping, swing trading, momentum trading, options, crypto, thinking that variety equals success. Wrong. Minervini says that the real winners focus on a specific strategy and master it inside out. Instead of trying to trade every stock in every market condition, you should pick a proven strategy like VCP or growth stock trading and study it in depth. Stick to specific market conditions where you excel. Bullish, breakouts, earnings momentum, etc. Keep refining that one strategy until you have an edge over 99% of traders. The key here is that specialists get paid, generalists get wiped out. When you focus on one powerful method, you develop intuition, confidence, and a repeatable process that consistently delivers profits. 2. Keep it simple. Avoid the analysis paralysis trap. New traders love fancy indicators, complicated algorithms, and 20-chart setups. But the harsh truth? More complexity equals more confusion. Minervini emphasizes that simplicity is key. Super performance traders keep their process straightforward and effective. Here's what that looks like. Price action first. Learn to read price charts without needing 10 different indicators. 1 or 2 confirmation indicators. Moving averages? Volume spikes? Pick what actually works. Stick to the fundamentals. Strong earnings growth, institutional interest, and clear trends matter most. Don't second-guess yourself. Overthinking leads to hesitation, and hesitation leads to missed opportunities. Simplicity ensures that you can execute consistently, and consistency is the foundation of winning in the markets. 3. Be disciplined. Follow your trading plan. No exceptions. Let's be honest, discipline is where most traders fail miserably. Minervini says it loud and clear. Your trading plan is your lifeline. Stick to it, no matter what. Discipline means cutting losses exactly when your stop loss is hit. No excuses. Not jumping into random trades just because you're bored. Taking profits without getting greedy. Not chasing a stock after you miss the entry, there's always another trade. If you don't have ironclad discipline, the market will punish you. Every blown account starts with, just this one time, I'll break the rules. Don't let that be you. 4. Manage risk. Protect your capital like your life depends on it. Minervini hammers this point in every chapter. Risk management is everything. You can have the best strategy, but if you don't control your losses, you'll wipe out your account in no time. Here's what rock-solid risk management looks like. Never risk more than 1 to 2% of your capital on any trade. Always use stop losses. Hope is not a strategy. Position size correctly so one bad trade doesn't wreck your entire portfolio. Avoid over-leveraging. Trading on margin can kill your account fast. Super performance traders don't focus on making money, they focus on not losing it. 5. Stay flexible. Adapt to market conditions, like a pro. The market changes constantly, and if you're stubborn, you'll get crushed. Minervini explains that successful traders adapt quickly. If the market is in a strong uptrend, press your advantage, take bigger positions. If the market is choppy, pull back and stay defensive. If a stock doesn't behave as expected, cut it loose fast, no hesitation. Flexibility means you trade what's happening now, not what you wish was happening. 6. Be patient. Only take high-quality trades. This might be the hardest rule to follow. New traders want to be in the market every single day, but that's how you get burned. Minervini stresses that patience is a trader's greatest weapon. Wait for the right setup. Don't force trades. Sometimes the best trade is no trade at all. Quality beats quantity. One great trade is better than 10 mediocre ones. Super performance traders sit on their hands until conditions are perfect. When it's time to strike, they go in big and with conviction. 7. Maintain a positive attitude. Mindset is everything. Trading is brutal. You'll take losses, you'll feel frustrated, but if you let negativity take over, you're finished. Minervini says top traders have a winner's mindset. They treat losses as learning experiences, not failures. Don't blame the market, they take responsibility for their trades. Stay confident, even when things aren't going well. Your attitude shapes your success. Stay positive, stay focused, and keep pushing forward. 8. Commit to continuous learning. Never stop improving. Here's the truth. Most traders quit too early. They blow up their first account and give up. That's not how champions are made. Minervini's final rule? Never stop learning. Study the best traders in history. What did they do right? Track your trades, analyze your mistakes and fix them. Read trading books, attend seminars, and keep improving. Treat trading like a business, not a hobby. The best traders stay students of the game forever. If you apply these 8 principles consistently, you're already ahead of 99% of traders. Now it's time to put them into action. The champion trader mindset. When it comes to trading, the biggest battlefield isn't the stock market. It's your own mind. In this final chapter, Minervini dives deep into the psychology that separates successful traders from those who struggle. He makes it clear, no matter how great your strategy is, if your mindset isn't right, you'll never be able to execute it properly. So, what does it really take to develop a champion trader mindset? It all starts with self-awareness. Most traders don't fail because of a lack of knowledge. They fail because they can't control their emotions. Fear, greed, hesitation, and overconfidence, these are the silent killers of success. Minervini emphasizes that traders need to recognize their emotional tendencies and actively work to keep them in check. One of the biggest challenges in trading is handling losses. Even the best traders in the world lose money sometimes. But what sets them apart is how they react to those losses. A losing trade doesn't mean you are a failure. It's just part of the game. Instead of dwelling on mistakes or trying to make back money immediately, great traders step back, analyze what went wrong, and move forward with discipline. Another crucial aspect Minervini highlights is the importance of confidence, but not overconfidence. Confidence comes from preparation and experience. If you've put in the work, tested your strategy, and know your edge, then you can trust yourself to execute trades without second guessing. However, The moment a trader starts thinking they can't lose is when they are most vulnerable. The market humbles everyone eventually. Patience is also key. Many traders feel the need to be in the market all the time, fearing they might miss out. But Minervini reminds us that trading isn't about constant action. It's about waiting for the right opportunities. Sitting on the sidelines when conditions aren't favorable is a skill in itself. The best traders don't chase. They position themselves strategically and let the market come to them. Lastly, Minervini stresses the power of a positive mindset. Trading is tough, and setbacks are inevitable, but those who succeed are the ones who stay resilient. They don't let a bad day shake their long-term vision. Instead, they treat every experience as a lesson, continuously improving and refining their skills. That's a wrap for Think and Trade Like a Champion by Mark Minervini. I hope you found these strategies, tips, and insights valuable for leveling up your trading game. If you found this content helpful, make sure to like, share, and subscribe so you don't miss any more trading wisdom. Your support means a lot, and it helps me bring you more powerful content. Also, if you missed our last video on The Hour Between Dog and Wolf by John Coates, trust me, that's another gem you don't want to miss. It dives deep into the psychological side of trading, and it's packed with insights that can change the way you approach the markets. Thanks for tuning in, and I'll see you in the next one. Happy trading.